A very good evening to you all. Respected dignitaries of the dais, respected members and dear students. I am highly privileged to introduce one of the famous personalities of Mumbai, CA Gautam Nayak today. He is into practice as a chartered accountant since 1986. He is a partner of the firm of C&K and Associates LLP, formerly known as Contractor Nayak and Krishna Dwala Chartered Accountants, Mumbai. He has held various positions in BCA. He was the president of the Bombay Chartered Accountants Society in 2004, 2005, and he has been in very many taxation committees. He was the chairman of the taxation committee of the BCAs from 2011 to 2004, and very many such posts have been held by him. He is a co-author and author of many publications, co-author of 4 editions of Transactions in Shares and Securities, Taxations and Accounting published by BCAs. He has written a number of articles, and to name a few, has contributed articles on taxation to other newspapers and publications such as Economic Times, Outlook Money, Outlook and Open. He has presented a lot of papers. To mention a few talks and papers and seminars organized by various professional bodies, talks at programs and trainings by corporates and others such as IMC, Chamber of Commerce, Mumbai Chamber of Commerce and Industries, CRISIL, National Academy of Direct Taxes. He has appeared on CNBC, CNN and Bloomberg as a panelist on various panel discussions on taxation and audit. Ladies and gentlemen, please join your hands in welcoming today's speaker, Gautam Nayak. Welcome, sir.
Over to you, sir.
Good evening, friends. It's a great pleasure to be with all of you today to discuss this topic of taxation of charitable trusts. The topic is on recent amendments and issues. And if you look at the recent amendments, I think I was looking at the last finance bill, and maybe around 35 to 40% of the pages were devoted to charitable trusts. Even the earlier year's budget, there were quite a few significant changes. And I think this is a trend which we are seeing over the last few years, starting from 2009. We saw the infamous proviso to Section 215 coming in to the amendment to the definition of charitable purpose, where they said that if your activity in the nature of advancement of any other object of general public utility is, if any activity is in the nature of trade, commerce or business, or in relation to trade, commerce or business, in that situation, the trust would lose the exemption. So starting from there, and if you look at this, it really is seeing a conscious shift in the government attitudes towards charitable trusts. One is seeing that over the last 3 or 4 years, this has grown more. Just look at the FCRA position. Under the Foreign Contribution Regulation Act, trusts which were registered, we had 40,000 trusts which were registered earlier. That 40,000 trusts reduced to 16,000 because 24,000 trusts registration was cancelled. That further, out of the 16,000 trusts which applied for renewal of registration 2 years ago, we see that hardly 4,000 trusts registration has actually been renewed. 12,000, they're being subjected to some sort of audit, and then the registration is being renewed. So therefore, that is one sea change in the attitude which we are seeing. The other thing which I would advise all of you who deal with charitable trusts to do is read the recent CAG report of August 2022, the performance audit report on charitable trusts, which the CAG has tabled before Parliament. There the approach which the CAG has taken, the way, the recommendations that they have made, one will see, that this is coming in, is likely to come in the form of some more changes in the provisions relating to charitable trust, some more tightening of the position, because what is being seen is the CAG is pointing out cases where there has been abuse of the process of exemption by charitable trust, and therefore has recommended that yes, please change the law, please change this, please plug this loophole, please link your income tax to the FCRA during the course of tax assessment, look at the FCRA spending, etc. So all these things are is something which is sure to come. The last CAG report, what was suggested, half of that has come already in the form of the amendment. So this is something which one has to come to expect, that yes, there will be significant changes which will take place. One will have to be prepared for these changes. And very often when one is asked by a client, should I set up a charitable trust? I want to do charity. Very often the advice which we give him is, unless you are willing to run a business, or maybe you have compliance more than a business, it's only then that you think about setting up a charitable trust. So that's what it has come to. I think in the olden days it was much easier running charitable trust, but today it is an extremely difficult job. So now let's go on to this is what I will be covering. There are quite a few amendments, as I said, and then I will deal with 2 or 3 major issues which have been come up. So what I will do is I will just touch upon, though we have 45 slides, we just have time maybe to quickly touch upon the issues in each of these. So the first amendment which came about by the Finance Act 2021 was that as you know, you have hospital and educational institutions. So if it's a medical institution or an educational institution, you have clauses 6 and 6A. If it is not aided substantially by the government, if it's not substantially financed by the government, or if its turnover was more than 1 crore, the gross receipts figure has now been increased to 5 crore. But earlier that limit of 1 crore was per institution. And what did you mean by institution? Say you have a society which runs 4 schools and 6 colleges. Each of the schools and those colleges was a separate institution, and you had to look at the 1 crore turnover limit for each of those institutions. Each of those institutions would have to be approved. That was the position. Now what they've said is, look at the SSE. And who's the SSE? The SSE is the society which is running these 10 institutions. Is the gross receipts of the SSE from all these institutions put together, is it more than 5 crore? If yes, then you need to be approved. Otherwise, your income is exempt without any conditions. So that is the one significant change which one sees over here. Then the second thing is, so far, your 12A registration, your 12A, 12AA registration which you had, as you know, that was a one-time registration. ATG also, in 2009, they said that, okay, if you're registered, then it is permanent, that registration, that approval. You don't need to come back to us every 3 years or every 5 years, ATG, which was earlier every 3 years or 5 years you had to go for renewal. So that also they have amended now. Now the position is, as you know, all these trusts which were registered under 12A, they had to seek re-registration under section 12AB, and that period was up to 31st March 2022, you had to seek that registration, re-registration. So even if you had ATG also you have to take re-registration. If you had 1023C approvals, that also you had to go in for re-registration. That was the position. So this registration again is going to be valid only for a period of 5 years without, it will be automatically granted to those who are already registered earlier. So most of you would have received that immediately within 15 days, 20 days. It was an online process, so you would have received that. And they would have allotted a unique registration number for each registration. So if it is a 12A registration, a different number. If it is an ATG registration, a different number. And now before the expiry of this period of 5 years, you have to apply for renewal 6 months before the expiry of that approval period. So therefore you have to remember that 6 months prior to the expiry, you will have to apply for renewal of that. Now what is I think, there are a large number of trusts which were registered earlier under 12A or 12AA, and they have not been able to make the application in time before 31st March 2022. What happens to such trusts? Now such trusts, there is, what should they do? One option to them is that you make an application now and you seek condonation of delay from the CBDT. under section 119 of the Income Tax Act, you can make an application for condonation. In fact, I'm told that there are a large number of trusts which have done that. They have sought condonation of delay from the CBDT. But at the same time, they have made an application for new registration also, and they have been granted this provisional registration as if it's a new approval. So, at least so from 2023-24 onwards, at least they will get the benefit of the registration, if not from assessment year 22-23. But if they are not registered under section 12AB now, they will not get the benefit of the exemption under section 11 for assessment year 22-23. So when you're doing the audit for assessment year 22-23 under section, the form 10B, the audit report which you have got to do, at that point of time, you will have to verify whether the trust has renewed its registration under section 12AB or not, whether it's got a renewal certificate before 31st March 22, it has applied for and got that certificate or not. This is something which you'll have to take care. And if it has not, then you will have to advise them, make an application now and seek condonation of delay from the CBDT. Also make an application for new registration currently, So that is something which you will have to do. So if it's a new trust, earlier what would happen is that they would scrutinize all the documents, and then after 6 months the CIT would grant you the exemption. Now what they have done is they say that you make an application online for new registration. We will grant you a provisional registration. This provisional registration is valid for a period of 3 years, or in case you commence your activity before the expiry of that 3 years, within 6 months of commencement of activities, you come to us for seeking the final registration. Now, when you go for the final registration, at that point of time, you will have to submit various documents, which is much more detailed, unlike the case of existing trusts which are registered where the renewal is automatic. Here, the CIT will go through all the documents and decide whether you are eligible or not. The question is, when they say within 6 months from commencement of activities, what do you mean by commencing activities for a trust? Does it mean that when it opens its bank account? Does it mean when it starts receiving donation? Does it mean when it starts hiring employees? Or say, for instance, you're looking at putting up a school, and does it mean when you start looking out for land for that school? Does it mean when you buy the land? Does it mean when you start construction of the building, when you complete construction of the building, or actually start running of the school? I think there is a complete lack of clarity here. And in most cases, we advise clients that please apply for registration at the earliest, as soon as you start some activity. So if today you are entering into an agreement for purchase of land, immediately seek registration saying that I have started. The moment you spend on your objects, that is the way I would look at it. The moment you start spending any expenditure on your objects, that is the stage when your activities has commenced. Look at it that way. And now the question is, what if there's a delay in the application? Would it be fatal to registration? I think no, the tribunals, etc., I'm sure they will read this down, that so long as you have made the application, doesn't matter if it is late, that should be good enough. So, the other thing is, of course, like earlier also, if you modify the objects, you've got to seek renewal of registration. You've got to go back for the commissioner for registration here also. And there is one more clause over here, that due to the application of first proviso to section 11(7), if your registration has become inoperative, you want to make it operative, then again you have to make an application. And what is 11(7), this proviso? Earlier, you could be registered under 1023C, you could also have your registration under 12A. Now under 11(7), what they say is that you have to choose between 1023C and section 12A. You select which this you want. You cannot have both. So you will have only one. So if today you are registered under 12A and you opt for 1023C, then you will be granted 1023C, but your 12A registration will become inoperative for that period of time. Subsequently, you can shift back once back to section 11 and 12 exemption by saying that, okay, I'm cancelling my registration under 1023C, and then you have to apply for making your registration under 12AB operative. So that is the case. So in that case also, there will be a proper scrutiny, a thorough scrutiny of all your documents. In fact, now the question is, after 5 years, what will happen? Can you imagine? I was talking to the DIT exemption in Mumbai. I said, sir, you have got 60,000 trusts registered in Mumbai, which are registered under 12AB. After 5 years, all 60,000 of them will come for renewal of registration. Out of those 60,000, maybe 30,000 have got 80G registration also. So they will come for 80G also. So you will have 90,000 applications, plus assuming that there are another 1,000 new trusts, so 91, 92,000 applications. Can you deal with those applications within a period of 6 months? He says, no, impossible. So, probably what we'll have to do is we'll have to do it on a test check basis, etc. Now, but I think this has not been thought through by the government, unfortunately, when bringing in these amendments. This is something which is going to create a problem, and I think let's wait and see how the law develops further when this renewal of all these 12AB registrations comes in. Now, the other thing which has come in the amendment is that the registration under section 12AB can be cancelled in case of certain violations. As you know, under section 12AA4 also you had a provision where if there were certain violations, the registration of the trust could be cancelled by the commissioner. The commissioner had to conduct an inquiry. Here also the same process. The only question here is it's not only coming to notice of the commissioner, it's the officer also who can make a reference to the commissioner if he comes across a violation. Similarly, a case where the CBDT notices this under the risk management strategy framed, right? Now, what is this risk management strategy? Nobody knows. It's something which unfortunately is not public. That's something which maybe the government needs to look at whether there should be public this risk management strategy, because risk management strategy leaves it open to anything and everything, frankly speaking. Even for reassessments, the same thing, they talk about risk management strategy. Now that is something which, government needs to make it public. What is this risk management strategy? Because otherwise, anything and everything can be done under the guise of risk management strategy. The procedure is that the commissioner will call for documents, make an inquiry, but he has to pass an order in writing after giving the opportunity of being heard. So, if the violations have taken place, he will cancel the registration for the year in which the violation has taken place, and all the subsequent years that cancellation will be valid. The order is to be passed within a period of 6 months. Even if he feels that there is no violation, then he has to pass an order saying that, okay, I am not cancelling the registration. So he has to pass, refusing to cancel the registration, pass an order. And of course, send a copy of that order to the AO. Now, what are those violations? If you look at it, what was the position earlier and what is the position now, so far as those violations are concerned? Earlier, the position, one of the violations was if the activities of the trust are not genuine. Now, it says, in addition to activities of the trust not being genuine, another thing is that if the activities are not carried out in accordance with all or any conditions subject to which the trust was registered. So, the conditions of registration also have to be complied with. If there is a violation of any one condition also, it can be cancellation. Then earlier it was the specified violation was activities are not being carried out in accordance with the objects of the trust, which means generally your activities are not in accordance with the objects, then they could, so if a significant part of your activities is not in accordance with your objects, it could be cancelled. Now what they have said is any income applied other than for the objects of the trust. So let's take a situation of where you have a school or a hospital. Its objects are purely educational or purely medical. It gives a donation to the Prime Minister's Relief Fund for disaster relief. That is not in accordance with its objects. So technically its registration can be cancelled. Now, so this is something which is there, which is, then earlier you had a provision that where the provisions of 13(1)(c) or 13(1)(d) were attracted, there the registration would be cancelled. Now that condition has gone away because of an amendment in the law. We will see what that amendment is and how it works. There was this non-compliance with the requirement of any other law material for the purpose of achievement of which that continues over here. Plus now there are three more specified violations, that if a trust has income from profit and gains of business which is not incidental to attainment of its objects, or if separate books of accounts are not maintained in respect of business incidental to attainment of objects, in that situation the registration can be cancelled. So any business activity, separate books of account, non-maintenance can attract. We'll look at each of these conditions in a little bit more detail when we go a little forward. Then if any part of the income is applied for private religious purposes which does not endure for benefit of public. Now this is a situation where you have a private religious trust, etc. But that goes without saying. It's only a public religious trust which is eligible, but private, so if you spend for a private religious activity, that may not be qualified. And last, one more thing has come in, which is drawn from 13(1)(b), that if it applies any part of its income for the benefit of any particular religious community or caste. Now, this is of course for trusts which are set up after 1/4/1962. Trusts which are established prior to 1/4/1962, there is no problem. So we'll look at each of these a little bit more in detail. Now, what do you mean by activities not genuine? You had the Supreme Court considering this in the case of Bhatanagar Education Research Trust, where bogus donations were returned in cash by a trust. Supreme Court said that yes, this can result in cancellation of registration because this is activities are not genuine. Bombay High Court in a case said that if a partial expenditure which was not authorized by the trust deed, that would not make the trust non-genuine. Of course, today you have that provision that if you spend anything for other than the objects, then that would attract. But this is the Bombay High Court also looked at the proviso. If the proviso to Section 215 applies, that does not mean that the activity is not genuine. Just because you're carrying on a business, that does not make your trust non-genuine. Now, in a case where you spend money outside India, for instance, now 11(1)(c) applies there, unless it's approved by the CBDT, you cannot spend outside India. And there the Calcutta High Court looked at it and a situation where amount was spent outside India without the permission of the CBDT. And they said that no, in such a case, you cannot say that activities are not genuine. It is a genuine activity, though it has carried it out outside India. So you cannot, this would not result in a cancellation of the registration. Now, let's look at this clause. Activities not carried out in accordance with all or any of the conditions subject to which the trust was registered. Now, what was the condition being stipulated? If you know, if you had applied for early in June or July, you would have got a certificate of provisional registration. Instead of final registration, though it was given for 5 years, it mentioned provisional certificate of registration. And it was a 2-page order laying out various conditions. Now, one of the conditions is, as and when there is a move to amend or alter the objects or rules and regulations, prior approval of the commissioner. Now, where is the requirement of prior approval? If you change your objects, you have to go back to the commissioner under 12AB. That's what the law requires. But why do you have to go for, suppose if I change, say instead of 3 meetings a year, I say the trust will hold 4 meetings, or instead of 5 trustees, it can have 10 trustees. Why do I need to go to the commissioner? And why do I need prior approval of the commissioner? This was something which was really not required by law. Then in dissolution, of course, surplus assets shall be given to organizations as similar objects, which is, I think, in any case required. 115 TD you will pay if, it's converted into any form which is not charitable or is merged into any other entity, etc. So, which is there, 115 TD, that's the provision of law. Now, one more condition which was laid down was, the trust shall quote the PAN in all its communications with the department. So, you write a letter to the officer for recovery of taxes, he written a letter and you write, I forget to mention the PAN. Now, so that can result in cancellation of registration. I think this was ridiculous. It's a requirement of law that yes, you mention your PAN, but that cannot result in cancellation of registration. Then, no change in terms of trust deed or memorandum shall be effected without due procedure of law, and the intimation shall be given immediately to the office of the judicial commissioner, and that is fine. I mean, that, but not a prior approval. Then the other requirement which came in is that now trust shall maintain accounts regularly and shall get these accounts audited. That's fine, which is the requirement of law. But separate accounts in respect of each activity as specified in the trust deed shall be maintained. Now that means if you have medical activities, you have educational activities or some other activity, you have to keep separate books of accounts. And is that sufficient? Is it each object? Or will the officer say, no, if you are running a school, that is a separate activity. If you are giving scholarships, that's a second activity. If you are running a hostel, that's a third activity. For each of these, you have to keep separate books. And therefore, this is something which was ridiculous and it's not required by law. And another horrible thing was a public notice of the activities carried on or to be carried on, and the target group intended beneficiaries shall be duly displayed at the registered office or the designated office of the organization. So if you don't have that board which says these are my objects and these are the intended beneficiaries, then my registrar can cancel it. It's ridiculous, again, something which was. Then trust shall furnish a return every year within time limit. Now that cannot result in cancellation of registration. If I don't file my return within time, there is a provision in law which says that I will lose my exemption for that year. But that cannot result in cancellation of my registration, that is going beyond the law. Then another thing was registered office or principal place of activity shall not be transferred outside the jurisdiction of the jurisdictional commissioner except with prior approval. Now where was the requirement of prior approval? It's not like your company law board approval, you take file shifting from one registered state to another registered state. This was nowhere laid down in the law, but this was something which was. And the worst thing was this: no asset shall be transferred without the knowledge of the jurisdictional commissioner to anyone, including to any trust, society, non-profit company, etc. Now, when you spend on your objects, what are you doing? You're spending money, you're transferring some asset of the trust. So that means for every check you write, you have to inform the commissioner. or without taking his prior promotion. Without his knowledge, you cannot do this. Now, this was ridiculous. In fact, I remember the DIT exemptions, when I brought this to his notice, he said, I've got some 300 application people saying I want to transfer this asset. Now, I don't know where is the requirement under this to give me permission? Where is the requirement under the law? So, but this was the ridiculous provision which was there. Then all public money so received, including for corporates, shall be routed through a bank account whose number shall be communicated to the commissioner. Now, this again is something which is not required by law. And again, then you had a worst thing was the blanket. Applicant shall comply with the provision of the Income Tax Act, read with the income tax rules. So you file your TDS return late, what happens? It's violation of the income tax rules. You lose your registration? Ridiculous. I mean, this was the way, these conditions. And I understand that, in discussion with the commissioners, he says that the exemptions department was never consulted on this. This was drawn up, God knows, somebody who did not just picked up something from different places and put this together. This was challenged, many of these orders were challenged before the tribunals. The Bombay Tribunal, there are 2 or 3 decisions of the Bombay Tribunal, couple of them I've given over here, where they said that the commissioner cannot impose conditions for grant of such registration, what the Bombay Tribunal said. In another case, they said that commissioner cannot dictate how cancellation should be made. It is only the law which can provide that. So commissioner cannot lay down conditions, and if you don't fulfill those conditions, then your registration can be cancelled. So this was what the Bombay High Court said. And they said, again, in this case, they said that registration cannot be a provisional registration. It has to be a final registration. It is not a regular registration, not a provisional registration. So then, I think when this was discussed, I think we had taken this up with the commissioner. I'm told that other people also had taken it up. And finally, the suggestion was that you come out with a circular so that all the past thing can be. So a sub-CBDT circular came out in 3rd June 2022, saying that, these conditions need to be revised to align these with the amendments made by the Finance Act. And the conditions shall be read as if these conditions have been substituted with the conditions provided in this table 1. And that provisional registration, provisional approval shall read as registration or approval. And that provisional registration number shall be read as a unique registration number. So this was what the circular said. So what is this table A, what they have laid down? Now, table A has 4 or 5 parts. Now, case of renewal, I will just, that income derived. So these are normal conditions which are there under law, what they have read down, that no non-genuine activity shall be carried on. So which is there, which can result in cancellation, which is there in the law. Now, those are the provisions which have come in, fortunately. So whatever are those conditions contained in your provisional certificate of registration or the certificate of registration which is granted to you under 12AB, those will be substituted now with these conditions. That, you shall comply with, you shall not apply for benefit of particular religious community or caste. So which is there, which are the specified violations which we saw, those have now been come in. And, of course, if you've furnished false or incorrect information, which the rule provided that your registration can be cancelled, that also has come in over here now. When, of course, you modify your objects, you go back to the commissioner, etc., all those conditions have come in now. Now, let's look at some of the other specified violations. One is that any income applied other than for the objects of the trust. Now, as I gave you that example, a school which has only education as its objects, it gives, its income is say 10 crores and it gives 10,000 rupees to the Prime Minister's Relief Fund, or it gives a lakh of rupees to Prime Minister's Relief Fund. Now, in the context of the total income, it is a minuscule amount, and I would say in a few less than 1% also. Now, can this result in cancellation of registration? I think probably the intention is that a substantial amount you don't spend on the objects. Maybe this 20%, the courts or tribunals may read this down and say that this 20% limit which is there under the proviso 2215, that 20% limit may come be read into this section. It may be read in over here. So that's possibly this. Now, of course, the problem really is this, that again you need to look at this carefully, that if a trust spends for charitable purpose, though those charitable purposes are not within its objects, still that is not permissible. That can result in cancellation of registration. That is something which you need to advise your clients, because very often we see that the trustee says that this is anyway a charitable purpose, let me spend on this, even if it's not there in my trust deed. Now, I think it's very important that you get the trust deed amended before you spend for that particular thing, which is not permitted under the law. So that is something which you... Now, of course, the question is, if you have received a tied-up grant and you spend out of that tied-up grant, or you spend out of a corpus donation. Now, this talks about any income applied. So long as you don't apply any income for this other purpose, is fine. If you apply the corpus, yes, you can apply it according to me. So, or if you have received a tied-up grant, where the condition is that you have to spend it for that purpose, possibly yes, because the tied-up grant is a liability. Various courts have taken the view that it's a liability until such time as you spend it for that particular purpose, because there's an obligation to refund the money to the donor in case you don't spend it for that particular purpose. Also, what one needs to remember is, if a trust spends on something which is not within its objects, though it may be a charitable purpose, the trustee could be held liable for making good that. If tomorrow somebody moves, say for instance in Maharashtra we have this concept of charity commissioner, somebody moves the charity commissioner, yes, the trustee could be forced to make good that difference, so that's something which will apply. Then the next requirement is that if the trust has not complied with the requirement of any other law material for the purpose of achieving its objects, and the order, direction or decree holding that such violation has occurred has not been disputed or has become final. Now, what is the requirement? It has not complied with requirement of any other law material for the purpose of achievement of objects. What is requirement? Is the requirement to be material or is the law to be material? And I think it is the requirement which is material to the achievement of its objects. So, say for instance, you have a law like the Maharashtra Public Trust Act, which lays down procedural requirements really. It is not really on so much of spending on objects. Say for instance, if you take a loan, you need a prior approval of charity commissioner. To transfer a property, you need prior approval of charity commissioner. So, or your investment pattern has to be in accordance with the Maharashtra Public Trust Act. Now, those are procedural requirements. Or take FCRA. If FCRA deals with your donations, you cannot accept a foreign contribution unless you have prior registration or prior approval from the Home Ministry. Now, that has got nothing to do with the spending on objects. So, therefore, that is not material for the purpose of law, material for the requirement is not material for the purpose of achieving its objects. What is material for the purpose of achieving its objects? Say, for instance, you are running a hospital, and that hospital requires registration with the health ministry, etc., and you have not got that approval. Now, that could be the situation which is there. There could be running of a school without being registered, though it requires to be registered, etc. So, therefore, these are things which one needs to look at, that for furtherance of objects, is there some material requirement, and are you doing it by violating that law? That is the question. Now, for instance, very often the question is, what if a trust is running a school and the teachers have not been registered for Provident Fund, say for instance. They have just not registered for Provident Fund, or for professional tax, it is not registered. I think that is not material for the purpose of achievement of its objects. It is a teaching activity which is material for the achievement of its objects, and therefore that I think is something which you need to look at. Then the next case which can result in cancellation of registration is if the trust derives income from profit and gain of business not incidental to attainment of its objects. Now, you have section 11.4a which says that there is no exemption under section 11 for profit and gain of business unless the business is incidental to attainment of its objects and separate books of accounts are maintained in respect of such business. Now, firstly, whether an activity is in the nature of business or not, as you know, is highly debatable. The department has been trying to take a view that many activities are, though they are actually furtherance of objects, they are in the nature of business, is the view which they have been trying to take. But the courts have consistently held that mere earning of surplus, that would not make it a business. It will not amount to a business. And we have, for instance, the Allahabad High Court which said that running a hostel for the residents of students who are admitted in a dental college, the trust was also running in the dental college. Now, that would not make it a separate business. It's not a separate business, it's the main activity which is being carried on. You had, what about the Chamber of Commerce and Industry? We had the Supreme Court long back taking a view in Indian Chamber of Commerce and Industry saying that running, promotion of trade, commerce and industry is itself a charitable purpose. It's it falls under any other object of general public utility. So here the Delhi High Court recently had held that these receipts, when a mutual organization renders services to its members, the income for rendering specific services to members is not exempt. That is taxable under section 28. The rest of the income, such as subscription received from members, will be exempt on the grounds of mutuality. But if, for instance, it organizes a seminar and members attend that seminar, they pay the seminar fees, or it issues certificate of origin to the members. Now, those are circumstances where specific services are being rendered to members for which members are paying. Now that income is taxable under Section 28. Now the Delhi High Court has taken a view that though that income is taxable under Section 28, it does not make that activity a business, because that is an activity in furtherance of its objects. So therefore, still it would be entitled to the benefit of exemption. It will not lose the exemption on behalf of that. Similarly, you have educational institutions who let out their premises, the hall, they let it out for functions, etc., when it is not being used for the school purposes. So we had this decision of the Bombay High Court which says that letting out of a hall for marriages or sale and advertisement rights are not a regular activity undertaken as a part of business. So this would apply to all the limbs of the definition of charitable purpose. So therefore that's one thing, that's the difference. Whereas the proviso to 215 talks about this business activity only for the residual clause, that is any other object of general public utility. As you know, you have various limbs. You have relief of poverty, medical relief, education, then yoga, etc., or preservation of environment. So these are separate specified activities. In addition to these specified activities, there is a residual category, achievement of any other object of general public utility. Now, under that, if you carry on business, the proviso to 215 applies, and you lose your registration, the exemption for that year. You don't lose your registration. But here now they're saying that for any of these, if you carry on a business which is not incidental, then you will lose your registration altogether, and it will result in cancellation of the 12AB registration. Of course, that in case of advancement of any other object of general public utility where proviso to 215 applies, you also have that cap of 20%. Now there is no such cap. If you have the business or profession, irrespective of whether it's 20% or not, this would apply. That's the position here. And what do you mean by incidental business? And this is something which is very important. Very often, assessing officer says, no, this business is not incidental to your objects. Now, as you know that where you're carrying on some activity and you're charging for that activity, very clearly it is not incidental. Delhi High Court in GSI India has taken that view. Bombay High Court in the case of machine tools manufacturers said that if you're holding an exhibition for, say, the members association holding an exhibition, now that is not a business activity, that is part of your main objects, that's incidental activity. You have the Bond Foundation Trust, hospital running a chemist shop. Now that is incidental, business incidental to the main activity, and therefore that's been clearly established. The question here really is, say you have a business which is completely unrelated to your objects. Say for instance, you're running a school and you have a business of running, say, trucks on transport. Now that profit from the truck transport feeds your charitable activity, or you have some completely unrelated business activity which is feeding your charitable activity. Now there very clearly I think the position is, the Supreme Court in the case of the antitrust had taken a view that if a business feeds the main activities, charitable activities, that is an incidental business. We have this again, the department had challenged this after the proviso to 215 was inserted, saying that now the proviso to 215 says that irrespective of how it is applied, etc. Now that wording is absent over here in section 12AB. So therefore you have the Madras High Court, you have the Kerala High Court, which have taken a view that yes, if you have a business which is completely unrelated, but if the income from that business feeds your charitable activities, then that is a business which is incidental business, and that ratio according to me would still hold good so far as the 12AB registration is concerned. It cannot be cancelled, and particularly because these words are not there, irrespective of the nature or use of application or retention of the income from such activities, as is used in the proviso to 215. So that is something which I think we'll need to very much keep in mind, that any business could be incidental business so long as the profits from that business are being used for the charitable activity. The next, this is that separate books of accounts are not maintained for a business which is incidental to the main objects. So you have to, what do you mean by separate books of accounts? Which means that you should be able to extract a separate trial balance, not necessarily separate balance sheet income and expenditure, because balance sheet and income and expenditure you will have a consolidated one. You may of course have for each of the divisions, but ultimately you will have a consolidated one when you file the tax returns. But so long as you have separate trial balances you can extract, that's good enough. And the Bombay High Court has said that books of accounts different and distinct from those which are maintained in respect of charitable activity. That is what you mean by separate books of accounts. Similarly, the Delhi High Court has taken a view that full and fair earnings relating to business and amount related to charitable should be able to be capable of ascertainment from these separate books of accounts. So that is the thing. And therefore, in such cases where you have a doubt as to whether an activity could be regarded as business or not, according to me, it is advisable that you maintain division-wise accounts. Ideally, keep separate bank accounts for each type of activity so that there is very clearly you can have separate trial balances. If called upon, you can say that these are my separate books of accounts. You can give a separate ledger, etc. So that's something which I think is, it's crucial. Then applied any part of its income for private religious purposes which does not earn for the benefit of public. You have a similar provision under 13(1)(a) which says that nothing contained in section 11 shall operate so as to exclude from the total income in receipt thereof any part of income from property held under trust for private religious purposes which does not earn for the benefit of public. So in any case you are not eligible for registration earlier, but they are saying that if you apply any part of income, now the question is really again this: what proportion of income, what happens when you utilize the corpus and not the income? So these are things, but here, unlike 13(1)(a), if, the income under 13(1)(a), the requirement is that you should not earn any income which is for a private religious purpose. Here, you have to actually spend for a private religious purpose. So that is the difference over here. And what do you mean by private religious purpose? So if you spend for a religious function which is organized by a particular individual for his own home or etc., or for his own family, possibly that would amount to, so these are things which one needs to guard against. Then this is a very important thing that which I will deal with in a little bit more detail, that if a trust has applied any part of its income for benefit of any particular religious community or caste, which applies to trusts only created after 1st April 1962. Now this talks about particular religious community or caste. You have a similar provision under 13(1)(b). What does 13(1)(b) says? Nothing contained in 11 shall operate so as to exclude any income. In the case for charitable trusts or a charitable trust created after the establishment of this act, any income if the trust is created or established for benefit of any particular community or caste. So if it is created for benefit of any particular community or caste, was where 13(1)(b) applied. Now here, if you apply your income for benefit of any particular community or caste, now this of course applies only to a charitable trust, it does not apply to a religious trust. Charitable cum religious trust, the Supreme Court in Dawoodi Bohra Jamaat looked at this in the context of 13(1)(b), and they said that if you're carrying on a religious activity, it will necessarily be for the members of a particular community. But if you're carrying on a charitable activity, say for instance in Dawoodi Bohra Jamaat, the situation was where the trust was spending for feeding poor people on a holy occasion, and it was outside the masjid, they were spending it. So question is, the Supreme Court said that who are the people who are feeding? Anybody who comes there, if you're feeding, which is fine, you are spending it for not for the benefit of any particular community or caste. It is a general charitable activity. So a charitable activity has to be for the benefit of general public. It cannot be for the benefit of only particular community or caste. That was the view which the Supreme Court took. And now here, if you find you had certain exceptions in 13(1)(b), a trust for the benefit of scheduled caste or backward community or scheduled tribes or women or children, they say is not to be regarded as a religious community or caste. It's a separate religious community or caste. That provision is not there, similar provision is not there under section 12(ab). Now, what happens to a trust which gives preference to members of a particular community or caste? Now in Mumbai, for instance, there are colleges which say that only for Sindhi students, 50% of this is reserved. Or you have certain colleges saying only for Gujarati students, because these are minority institutions, so 50% of the seats are reserved. Now, would this amount to spending for the benefit of a particular community or caste is a question, and there it's a slightly debatable issue. You have the Pune Tribunal in the case of Vimlabai Jathar Charitable Trust, where the third member decision was that merely giving preference to students belonging to a particular community, other things being equal, it would not attract 13(1)(b). So if you have two people who are of the same caliber, one student from a particular and one from some other community, and you give benefit to a particular community, that's okay. So that is the thing. But you had a Kochi Tribunal decision in Muslim Education Society, where the view was taken that for the benefit of does not mean solely for the benefit of. Benefit would extend to any preferential or unequal treatment according to the members drawn from a particular religious community. A minimal intake of students, say 2% or 5% from other than the dominant group, would not enable it to claim as not being expressly or practically solely for the benefit of a particular religious community. Any preference by way of providing for a quota, management discretion according to the members of public, drawn on the basis of religious affiliation, be it for employment of faculty or staff therein, admission to the students, grant of loans or scholarships for study, etc., would amount to a benefit. Now, this is something which is going to create a bit of a problem. This is going to be, now the question here is, so if today somebody comes to your college is admittedly for everybody, all students, but he says that I want to create a scholarship which is only for the top student from this particular community. So the top 5 students from this community, you give 5 scholarships. Can you accept that? I think it's advisable that don't get into this, because if you do this, it's possible that the department will say that the scholarship, you have spent some part of your income only for the benefit of a particular community. Though it is something which is occasioned by the donor, still something you have spent it, and therefore this could result in a cancellation of registration. This is something which I think one has to be now extremely careful of. There has to be a lot of care taken by such minority institutions, particularly. The next set of amendments which I will deal with is, of course, as you know, this ATG, you had this new requirements coming in from 1st April 21, and for the financial year 21-22, you must have filed this declaration statement of donations. Now, so there's a provision under the law which is subject to verification under the risk management strategy. So just like your TDS statements, will these also be verified? Will there is a process that raise some sort of queries? Is it possible? There is, of course, a penalty, 2,000 per day to be paid, for delay in furnishing this, but it cannot exceed the amount for which the failure. The question is this 200 rupees per day vis-a-vis each donor that you look at? And of course, you have this form 10DB which you have to file online, etc. And where they said you have to aggregate the donations from a particular donor, and within that you give the different categories. If he's given in cash, if he's given by electronic transfer, if by check separately, if it is in kind separately, etc. And if joint donations are received, you proportionately attribute it, is what they've said. Now, this donation, as you know, the deduction will not be available unless the certificate in the prescribed form has been issued. The certificate was to be given to the donor by 31st of May. You have to file, obviously, the statement. But what was happening is that you file the statement on 31st of May. It would take 1 day for the department to process that and generate the certificate in form 10BE. When you file your 10BD, it would take 1 day. What happens to those which were filed on 31st May but generated on 1st of June? I think possibly that is something because of the departmental time. It's possibly that, yes, that would still be valid, should not attract any penalty. The question is, in this, what donations do you show? Do you show only those donations which are eligible for ATG, or where the donor wants ATG certificate? What do you do? Because the whole objective is this, they say that it is for the purpose of ATG. The worry is that if you don't show the donations, total donations over here, will they match it with the total donations received as per your accounts and say that the rest means that you don't have details, so therefore they are anonymous donations? Is that this? Because if you see in this, there are also donations in kind you have to mention. Now, very often you have foreign donors. Now, foreign donors don't have a PAN, they don't have an Aadhaar number. So, what is the identification you give? So, this is a practical difficulty which are there. Donations in kind. Now, donations in kind, again, what is the purpose of served? They are not going to get ATG. Or donations in cash exceeding 2,000 rupees, they are not going to get ATG. And I think it is something which is valid, that one can take a stand that I am giving only the list of donations, because it does not say the list of all donations received. It says you have to file a statement of donations which are eligible for ATG. The way I read it is, since it is found in ATG, it is those which are eligible under ATG is what you should give over here. And, that's the whole. Now, coming to a very important subject of corpus donations, now there has been a significant change in the exemption for corpus donations. As you know, corpus donations, the only requirement so far was that if they are made with a specific direction that they shall form part of corpus, the corpus donation would be exempt. So you had to have a direction from the donor in writing is what the department would insist upon. There was a dispute that, okay, if there was nothing in writing from the donor, but there was an indication from the facts of the case that yes, it was intended to be, say for instance, he gave it for a building, etc. So therefore, but that the courts had generally been taking that so long as the intention of the donor is clear, that would be exempt, because that is intended to be for the corpus, and corpus means capital. That was the view of the courts. Now, from assessment year 22-23, the amendment is that this exemption is subject to the condition that such donations have been invested or deposited in the mode specified in section 11.5 maintained specifically for such corpus. So what you need to do is, therefore, earmark the corpus investments separately. You would, and particularly for the financial year 21-22, when you're seeing the audit is being done, ensure that whatever is the corpus donation which has been received during the year has been invested separately. You show that definitely as part of corpus. Possibly in the past you may have utilized part of the corpus, etc. Some donations you might have given, the investment may be less than the corpus amount, that's fine. So long as the opening is different. But ideally, you earmark it, use something, ideally you should maintain separate bank account also. But earmarking is something which I think is essential now, because if you withdraw something from the corpus, that spending from that money is not treated as an application of income, as we'll see a little later. So that is where so as I said, then you have this expression 4, which says that application from corpus will not be treated as an application of income in the year in which you spend it. But in the year in which you recoup that corpus, that you reinvest that money back into corpus, in that year it will be treated as an application of income. So therefore, whatever you have reinvested back into corpus, out of what you spent from the corpus, that will be regarded as an application of income. What you spend out of the corpus will not be treated as an application of income. So you have similar amendments in section 1023C, you have the which is brought in. So therefore, now you need to also, when you're looking at the corpus exemption, you need to keep a track of the movement in the corpus investments. And starting point would be the balances of the corpus fund and corpus investments as of 31st March 21. And then, reduction of investments to be reduced from the application of income for the year, addition to investments over and above corpus donation for the year to be treated as application of income for the year, etc. And there is no time limit for recoupment of this corpus. So if you spend in year 1, but in year 10 you recoup that corpus, still in year 10 it would be regarded as an application of income for charitable purposes. So this is an illustration which I've given there and which you can go through later. I will not spend time on that. Then the question here, a few issues which arise. Within what period is this investment of corpus to be done? Have you to do it immediately as soon as you receive the corpus donation, or by the year end? I think it's sufficient if as on the year end it reflects as an investment in corpus. The typical problem which arises is that you receive some donation, corpus donation towards the end of the year, and if it's not invested, there is a bit of a problem. Though one can perhaps argue that I have invested it, but within a reasonable amount of time. I think that is something which the courts would probably agree with. The question is, would a deposit in a current account with the bank qualify? You have the Madras High Court decision which says that this is also a deposit with a scheduled bank, and therefore under 11.5 it is eligible, this thing. But I think it's advisable that at least put it into a fixed deposit, even maybe if it is for up to the end of the year, for 3 months, 1 month, 2 months, whatever it is, but put it into a fixed deposit rather than... and for how long do you maintain this corpus investment? There is no time limit. Corpus means capital, so therefore, as I told you that if you spend out of that, in that year, that will not be treated as an application of income. But so therefore, there is no time limit for which you need to. But what if you get a corpus donation and you spend it in the same year? Is it a double hit that you don't get it because it is spending out of corpus, and at the same time because the corpus is not invested, you don't get the benefit of the exemption under 11(1)(d)? No. That donation would then be regarded as a regular donation. It would not be regarded as a corpus donation because it has not been invested. And since you spent out of the regular donation, the income has been applied for charitable purposes during the year. So that's the way I would look at it. What if you receive assets other than immobile property? Say you have a medical trust. It receives a donation of an ambulance. Now, is this a corpus donation? Normally, yes, it's a capital receipt, so therefore it would have been a corpus donation. Now you will have to treat it as a regular donation. The amount of the ambulance, you treat it as an acquisition of an asset for capital purpose, and therefore it would be treated as an application of income. That's the way you will have to treat it. As I said, that you would have a mismatch of the fund and investment balances if the corpus donation is invested in immobile property. Now, immobile property, you may be depreciating it. You had bought you got, say, a building fund of 10 crores, you had bought a property for 10 crores. Then over a period of time, today the depreciated value of the property is 5 crores, but your building fund is still 10 crores. So therefore, there could be a mismatch, particularly on immobile property. That's something which will be there. But what you need to see is that future corpus donations which you receive, immobile property is a permitted form of investment of corpus. So therefore, that is not a worry. But it should be either invested in fixed deposits or in immobile property, etc. That's something which you need to keep in mind. If your corpus was already spent in the earlier year and now you recoup it, can you claim it as an application of income in this year? I think possibly, yes, you could claim this because this would not amount to a double exemption. That's the view which I... What about loans or borrowings? Now, loans or borrowings earlier, as you know, if you spent out of a loan or borrowing, that was treated as an application of income. When you repaid the loan, there was a CBDT circular number 100 of 1973, which said that this would be treated as an spending in the year in which you repay the loan. So therefore, you are getting a double deduction. Now that has been plugged from assessment year 22-23. Now, what they say is now, if you spend out of a borrowing during the year, that will not be treated as an application of income during that year. In the year in which you repay the loan, in that year it will be treated as an application of income. So that is the way. So similarly, you have a similar amendment in 1023C. But take a case where you had a deficit of an earlier year which was financed by a loan, and the loan is now repaid in assessment year 22-23. As you know, deficit also has lapsed, because deficit you're not allowed to carry forward any longer. That also has been plugged. You're not, whatever was the deficit as on 31st March 21 would have lapsed. So can an application of income be claimed by virtue of the circular 100 dated 24th January 73? If the deficit, it was the amount which you spent in the earlier year, you did not get effectively the deduction because of the fact that it was a deficit, and that deficit has lapsed, then I think there is a case to say that yes, this year it should be treated as an application of income by virtue of that circular of 1973, because it is not a double deduction again which I'm getting, because I had not claimed that in that year I had not gotten the benefit of and it being treated as an application of income. The carry forward of deficit, as I said, now excess expenditure incurred in earlier assessment year, you could set it off against the subsequent years. So if you had expended more than your income, that deficit could be set off against the subsequent year. We had a Supreme Court decision in case of Subro's Educational Society which had confirmed that, and in fact the review petition by the department was also dismissed. There was another Supreme Court decision where this view was taken, that so the law has been amended with effect from assessment year 22-23. So no set off or deduction for deficit of earlier years is now allowable. So this all deficit which you had incurred up to March 21, that you will no longer be able to set off against the income of subsequent years. Then the question of application of income on payment basis. Now this is the amendment which I think is something which is applicable from assessment year 22-23, and this is a horrible amendment, as I would say one of the worst amendments in this Finance Act. What does the amendment say? See, as you know, earlier what was the position? You had that old circular of 1969 where the CBDT said that the exemption is to be calculated based on the commercial concept of income. So you go by your income as per books of accounts. So what was happening is you're calculating your income as per the books of accounts. So whatever was the method of accounting which you are following, the income as well as the application of income, both of that we are taking on the basis of your method of accounting. So if you're on cash basis, you calculate your income as well as application of income would be calculated on a cash basis. Now what has happened is that the amendment as per the so if you are on mercantile basis, your income was on mercantile, your application was on mercantile, it was matching. Now they are saying that whatever is the method of accounting that you are following, your application of income will be allowable only when you actually make payment. So actual payment has to be made. That means effectively cash method has been brought in over here. So far as actual payment system has been brought in over here. Now therefore, when you talk about actual payment, obviously it would not apply to things like depreciation or write-off. Depreciation, you know, you can still get for assets where you have not claimed it as 100% as an application of income earlier. You still get that. So those cases of depreciation, etc., there is no question. Under cash method, also you don't have to actually pay. So still it would be regarded as an application of income. That cannot apply to it. But the problem really is this. You have section 145. As you know, 145, what does it say? Earlier, until 1989, you could follow either cash method of accounting, mercantile method of accounting, or even a hybrid method of accounting. And many SSCs used to follow cash for income and mercantile for expense. That was so they wanted to plug that. They said, no, you can't follow a hybrid method. So hybrid method is prohibited under 145. Now here what is happening is, you have a large number of charitable organizations which are structured as Section 8 companies or Section 25 companies. Now these necessarily have to follow mercantile system of accounting as per the Companies Act. They cannot follow cash system of accounting. So they cannot even change over the method of accounting. So you have your income being computed on a mercantile basis, but your exemption, application of income is computed on a cash basis. Now there's a complete mismatch. They're two completely different methods. How can you say for 145, hybrid is not good, but here 145 is good. For this it is good, hybrid you can have. I think this is complete, hypocritical attitude. It is something which is not really justified. It's something which, of course, they say that if you have already claimed something as an application of income in the earlier year on a mercantile basis, today you cannot claim it on a cash basis when you spend it today, when you actually pay it today. So this is the problem which you have. As I said, practical difficulties which will arise. And what was the explanatory memorandum saying? As is evident from the word application, it means actually paid. This is the position which has been held by different courts also. Now, frankly speaking, this is a completely wrong statement which is made over there. Because if you look at it, there was an Andhra Pradesh High Court decision which said that word applied could not be equated to the word spent. Amount sanctioned as donations but not actually spent would constitute an application of income, they've said over there. Similarly, now there was one Madras High Court decision which took the view which the CBDT is saying, which was affirmed by the Supreme Court, where what were the facts of that case? A reserve for donation was created, only resolution after the end of the year, and no intimation was given to the donee. That does not amount to an application of income, was what the Supreme Court held. But subsequent to that, there is another Supreme Court, Madras High Court decision, which went to the Supreme Court, where in the antitrust case, where the Supreme Court clearly said that if a credit entry is passed in favor of an educational institution which was aware of such credit and also drawing from such account, that would be sufficient application of the income for educational purpose. So credit is sufficient application of income. So it is by giving such wrong reasons that the law is being amended, frankly speaking. I think now here again, as I said, this applies only to application of income. It would not apply to, your expenditure of a charitable trust really, if you look at it, is of two types. One is application of income for charitable purpose. The second is expenses which you incur for earning an income. Now, take administrative expenses. Now, you may have, a school or college may have administrative expenses which are, say, for instance, administrative expenses of the teachers. They may have administrative expenses relating to the staff who are involved in managing the accounts of the college. Now, the administration expense of the accounts of the college is maybe an expenditure incurred for earning the income. But the administrative expenses of the teachers, etc., those expenses are an application of income for charitable purpose. So there is a distinction between the two. Say, for instance, you have a letting of property. If you let out a property and you pay the municipal taxes of that property, that is an expenditure of income, that is an income expenditure incurred for earning that income. And when you consider the commercial concept of income, if your rent is 100 and you spend 10 on municipal taxes, then your commercial concept of income is 100 minus 10, which is 90. Only that is reduced from there. The rest is an application of income for charitable purposes. So that's the distinction. So this amendment applies only to an application of income for charitable purposes. It would not apply to expenses which are expenses incurred for earning that income, which you can still continue to claim on the basis of method of accounting. So that is something which you need to remember. Now, practical difficulties which arise, it applies even to a capital expenditure on objects. As you know, capital expenditure will also amount to an application of income for charitable purpose. Now, a part payment, say, maybe pending for a property, purchase of a property because of pending certification or documents. Now, there you will be penalized because you have not actually paid it out. Now, you received a earmarked donation with a committed spending, but payment is pending because certain things have to be still done. So there, again, now this will create problem because the donation may be treated as your income, but the expenditure will not be allowed. Funds committed and set aside for a project, and the application will depend on the project's progress of the project. Now there, you will end up having to pay tax unnecessarily. Expenditure has been incurred, but the payment is not made by the due to pending verification or certification, say by an architect, etc. So the difficulty now that trust will face is that they will have to keep a reconciliation every year to track the expense in the accounts and that remaining to be claimed in the tax computation. So whatever is the expenditure of the year, how much has been claimed in this year, how much has to be claimed in subsequent years. So therefore that is something which one will have to now keep a separate track of. The reconciliation will have to be kept. So possible remedies, one is change your method to cash system, that's one, but as I said, it's not possible for Section 8 or Section 25 companies. The second is you opt to spend that income in subsequent year. That's something which you have an option, of course. The third is that you exercise, you accumulate for the period of 5 years under 11.2. That's the other thing that you can do, of course. So these are things which can, Then coming to the next set of amendments is that, as you know, when there's under 13.1c or 13.1d, if these provisions were attracted, the income of the trust was subjected to tax at maximum marginal rate. there was a controversy. 13(1)(c) is if you spend for the benefit of a specified person. 13(1)(d) was if your investment pattern is not in accordance with the investment pattern specified under section 11(5). So the department's view was that if you spend for the benefit of a specified person or you invest in a manner which is not specified under 11(5), then your entire income loses exemption and the entire income is taxable at the maximum marginal rate. That was the view which the department was taking. The Supreme Court held otherwise. In Father Mueller's charitable institution, the Supreme Court upheld the Karnataka High Court decision, which says that only the income from those specified investments was taxable at the maximum marginal rate. The rest of the income qualified for exemption. That was the view which the Supreme Court took. Bombay High Court was also, and the Madras High Court also had taken a similar view. And in the context 13(1)(c), the Bombay High Court followed the same logic, and they said that if you only the income which is utilized for the benefit of the specified person would be taxable at the maximum marginal rate. The rest of the income would continue to be exempt from under 11 and 12. So now from assessment year 23-24, this is an amendment which applies from assessment 23-24. There is an amendment that under 13(1)(c), only that part of the income will lose the exemption, which is what the Supreme Court said. But it would also attract a penalty now under section 271 AAE. And that penalty is 100% of that income applied for the benefit of that specified person. So that is something which they have brought in. 13(1)(d), now what they say is, the amount of investment that you make in violation, that is the amount which will lose the benefit of the given. So not the income from the investment, but that investment itself. To that extent, you will lose the benefit of the exemption is this. And such income which loses exemption under 13(1)(c) and 13(1)(d) will be taxable not at the maximum marginal rate, but it will be taxable at 30% plus the applicable surcharge or cess. So not the maximum marginal rate, so therefore it will not be taxable at 42.74%. It will be 30% plus, depending on the income. It may be much lower, it may be 35%, it may be 37%, depending on the income. Now, so far as the penalty under 271 AAE is concerned, it is 100% of the income applied where the violation is noticed for the first time, and it is 200% of the income where violation is noticed against in the subsequent year. And this is in addition to any other penalty. Say for instance under 270A there could be a penalty. So this is a double penalty in that sense. Now finding need not necessarily be by the AO, it could be by the Commissioner appealed also. But the penalty has to be levied by the AO. Now, what in a case where assets are utilized for the benefit of specified person? That was also a violation on the 13(1)(c). Say some of the asset of the trust is given for the benefit of a specified person without adequate compensation. Now there, what is the position over there? They are saying now only with such part of income. Would you say that whatever is the expenditure on those assets during the year, only that would lose the exemption? I think that's the way I would look at it. Say if there's a depreciation, if there's this thing which you have claimed as an application of income, that would lose exemption. Nothing else would lose the exemption. And the most important thing is, can penalty be automatic? I think no, there will have to be a show cause given. There will have to be, your reply will have to be considered by the AO. So therefore that is something which a procedure will have to be followed. As it can't be automatic. Now the next amendment which I wanted to deal with and which is again a serious problem, and this is an amendment with effect from assessment year 23-24. This is, so they said that earlier there was no books of account or anything prescribed. You could maintain regular books of accounts, you had to do an audit, so obviously you had to maintain proper books of accounts. Now they are saying that no, you are not maintaining proper books of accounts, so we will prescribe books of accounts. From assessment year 23-24, you have to maintain prescribed books of accounts and documents. And now on 10th August 22, last week, you had Rule 17AA which has been notified. And what are the books of accounts that they have prescribed? They are saying cash book, ledger, journal fine, copies of bills and original bills and receipts for payments made, any other book required in order to give true and fair view, so receipts, etc., all that you will have to do this. Then record of all projects and institutions run by the trust, details of name, address, PAN and Aadhaar if available of the donors. So all the donors, now earlier what was there in Form 10BD, it was only charitable trusts, because only charitable trust has to file, because if they were only got the benefit of 80G. So it was only charitable trust which had to do that. Now even religious trusts will have to do this. Name, address, PAN of all donors will have to be maintained. Otherwise, of course, for a religious trust, they can't treat it as an anonymous donation, but this is something which has to be maintained now. Then details of application of income and corpus with name and address of person to whom was made, with object for which it is made. So all the expenditure, which you spend on objects, you have to keep the name and address of the person and what was the object for which it is made. Then details of investment in specified mode, this was normally being maintained, then books of accounts, the important thing is that books and accounts have to be maintained at the registered office. Otherwise, a resolution has to be passed and intimation has to be given to the AO about the other location within 7 days of the resolution. So that resolution, I think, is something which you have to advise your clients that yes, please pass that resolution in this year and start maintaining books if you want to maintain at place other than the registered office of the trust. Now these books and documents have to be maintained for 10 years from the end of the relevant assessment year. What happens to the past records? See, normally you would say that, okay, for 6 years my assessment can be reopened, I'll keep it only for 6 years. Now they're saying for 10 years. For the past, I'm sure now this rule has come in only today. So for the past, they cannot insist that you maintain 10 years records, because if I've already destroyed 4 years records of earlier, say 10 to 7, if I've already destroyed, you can't say that, no, you should have maintained now, you bring them back, and you can't bring them back. So therefore, I think really this is something which would apply going forward. It would not apply for the past. It will apply from the financial year 22-23 onwards. That's the way I would look at it. But yes, past record which you are required to maintain, because for reassessment purpose, maybe 5 years, 6 years, you maintain those now, so for a period of 10 years. But the worst is, everything you've got to maintain. You've got to maintain your vouchers, you've got to maintain your receipt books, you've got to maintain. So earlier, what would you advise trusts is that, okay, once 4 years is over, generally there's very little chance of reassessment. Destroy your records, keep only your main books of accounts. So that should suffice, that was or keep fixed assets if you've acquired, keep those vouchers. That's it, that was but now I think it's something which you need to keep in mind that books of accounts is something which is a problem. The accumulation under 11.2, very often people used to make the mistake that if I accumulate for a period of 5 years, say for instance for the year ended March 22, if I have a surplus, I accumulated for a period of 5 years up to March 27. Now, people used to think that it becomes taxable in assessment year 27, 28. That is not the position. It was become, see, if you see the section 13, if you look at section 12.3, so there the position was 11.3a. It said it becomes taxable if you have not spent it in that year in which it expires, or in the immediately following year, it becomes taxable in that immediately following year. So it was not taxable in assessment year 27, 28, it became taxable in assessment year 28, 29. So you could still spend it in assessment year 28, 29 for that purpose and still get the benefit of exemption. Now that position they have changed. They have said that this will become taxable in that 5th year now. It will become taxable in that 5th year if you have not spent in the 5th year. So you don't get the time to spend it in the 6th year, 1 year less. That is the position. But this has given rise to an interesting issue. Now you have an accumulation which you have made in 2017 for 5 years, which expires on 31st March 2022. Now what is the law for assessment year 22-23? It says it will become taxable in the 6th year. So this year it will not become taxable. Now when you go to assessment year 23-24, what does the law say? That the accumulation which it becomes taxable in the 5th year. So that is the next year's accumulation will become taxable, not the year of 17, but the year ending 18, that will become taxable. What happens to 17? Frankly speaking, I think the safer view is that you take it that it will be taxable in assessment year 23-24, but I think, this is a lacuna which is there. Perhaps they may rectify it when they amend the next year's budget. Maybe there may be an amendment, but this is a lacuna which is there today. One good provision which is there, fortunately, is section 13.10, which has come in with effect from assessment year 23-24. Now this applies in 3 situations. Where the first provision, section 215 applies. That is, you have carried on any business activity in the nature of business, etc. That situation. Or if you don't file your income tax return before the due date, or the audit report is not furnished before due date. Earlier the position was you lost your exemption altogether for that year, so you paid tax on the entire income. That was the view. Now what they are saying is that we will allow you a deduction for the expenditure which you have incurred on objects of the trust. That will be allowed to you as a deduction. Only the net income will be taxed. But when you're calculating that expenditure on objects of the trust, we will not allow capital expenditure. We will not allow expenditure from the opening corpus. We will not allow expenditure from loans or borrowings. Depreciation of asset whose whole cost has been claimed as a deduction will not be allowed. Now, the problem really is this. If you make a contribution or donation to any person, that will also not be allowed. Now, what do you mean by contribution or donation to any person? Any person includes an individual. So if you give loans, if you give, say, scholarships to students, are you not giving that to any person? It's a contribution of a person. It's a donation to a person. Now, I think the meaning here was that it should be into any institution and not to any individual. So I think that seems to be the intention. But because if you reimburse medical expenditure to individuals, that may not qualify otherwise. I think that is not the intention. The way I read it, it has not to be given to any other charitable organization. That's the way it should be read, is my 40A 1A and 40A 3 will apply to such expenditure. You apply that just like you apply for application of income. And there will be no deduction of any the expenditure or allowance or set off of any loss. You have now one more provision is that this income, certain types of income will now be taxable at a flat rate of 30%. As I said, like 13(1)(c), 13(1)(d). This will be taxed at a flat rate of 30% plus applicable surcharges. Now, what are those incomes which fall under this 115 BBI, which is taxable at a flat rate? That income accumulated or set apart in excess of 15%, where accumulation is not allowed under specific provision of the Act. Now, I don't know what sort of income they are referring to because to my mind, there is no such income where accumulation is not allowed under any specific provision. But possibly they are referring to income which is left over, maybe, so therefore if you have not spent your income, maybe the rest of the income will be taxable now at a flat rate of 30%. You will not get the benefit of basic exemption under of 2,50,000 and the slab rates of tax may not be eligible now. That may be the way they intend to. Then income which is taxable under section 11B. That is where you had exercised that option to spend it in the subsequent year, but you have not been able to spend it in that subsequent year. In that situation, if that amount becomes taxable in that year, because there was no expenditure to that extent during the year. So therefore, that will also now be taxed at 30%. Then the unspent accumulation, the 5-year accumulation, if you have not spent it, the unspent accumulation which becomes taxable in the 5th year, now that will also become taxable at a flat rate of tax, if it is not spent for the purpose of accumulation within that period of 5 years, or, income losing exemption in 13(1)(c) and 13(1)(d), as we saw because of donations, investment pattern, or using the income for the benefit of a specified person, or income applied for charitable purposes outside India without approval of the CBDT. So that is again something which will be taxed at a flat rate of 30%. And they say that no expenditure or allowance or set off of loss will be allowable against such income. Now, the important thing is 1023C, what they've done is, they've tried the next set of important amendments is 1023C, they've tried to align it with section 11. They're saying that we want to bring them at par. Now, what is the pre-amendment, what was the position? There are 3 or 4 differences which are there. That, for instance, if an accumulation which was accumulated for 5 years was not spent, then under 1023C it resulted in loss of exemption. Under section 11, it was taxable in the 6th year. Option to spend in subsequent year was not there in 1023C, it was there under section 11. There was no form filing required for this accumulation for 5 years under 1023C, but under 11 it was required. Then applicability 115TD did not apply to 1023C trusts. It applied to section 12AB trusts, that is under section 11 and 12. Otherwise, I think capital gain there was one difference, and if a 1023C trust gave a benefit to a specified person, that was not taxed, they did not lose exemption. Under 1023C, under 11, yes, it would lose the exemption. So this was the differences. Now they've tried to bring it on. So they've said that you have to now file a form for accumulation for the period of 5 years. This will become taxable in the 5th year, just like under section 12, 11 and 12. You have to file your return of income within the due date, claim the benefit of exemption. If you file your return late, you will not get the benefit of the exemption, just like under 11 and 12. Then they've introduced provisions similar to 13(1)(c), where a penalty under 271 AAE will apply. 1310, which is you'll get a deduction for the amount actually applied if you've lost because of provisor to 215, etc., all those situations. 115 BBEI, which is a flat rate of tax. Now that is something which has also been introduced. And tax on accredited incomes, as I said, 115TD has been extended, to income. Now tax on accredited income, as you know, is a very deadly tax, because if the registration is cancelled, you have to pay tax at the maximum marginal rate on the fair market value of the assets of the trust as on the date of cancellation. That is which means effectively you almost have to wind up the trust in most cases. So that is now applicable also to 1023C trust. Unfortunately, there is a problem here. If you're 1023C, you get it cancelled and you go for 12AB registration, there is a provision for that. But here it seems to indicate that yes, 115TD will still apply. I think that seems to be a mistake which is there. That probably will be this. Now still there are two differences which remain between 1023 and Section 11. A 1023C trust is worse off than a Section 11 trust because of the fact I have to start numbering in the columns. He says, yes, sir, even my officers, they have to count, they come with a numbered, pre-numbered thing. Then only I understand. So I said, why do you want to have this? You just say that 6 and 6A, that is subclauses 6 and 6A, they will be deemed to be registered in 12A and follow 11 and 12 pattern. Simple. Make it simple. Why complicate that? So the smaller trusts, which is less than 5 crores, the smaller trusts or trusts which are wholly financed by the government, you continue that exemption under 1023C. So that's a complete exemption. You don't have all those conditions. So all those provisos can just go away. I think that is, in fact, I remember earlier you had a very simple provision, 1022 and 1022A, which was there. It was just 3-line provision. And now you have such a horrible provision. I think it's the worst provision of the Income Tax Act so far in all these years. One beneficial exemption which is given is that if a trust which is receives certain money which runs a temple, mosque, gurudwara, church or other place which is notified under 80G2B, so which is a place of archaeological, artistic importance or place of public worship or renown, then and you have trusts, say in Bangalore you have this Subramanya Swami temple Ursur or the Tirunara Swami temple Melkote or Kadri Shri Manjunath temple at Mangalore. You have these which are there. And the latest is the Sri Ram Janmabhoomi Janmashetra, Tirtha Kshetra is there. Now these trusts which have been notified under 80G2B, if they receive a voluntary contribution, though it is not towards the corpus, they can opt to, if it is for the repairs of a mosque, repair or renovation of a temple, mosque, gurudwara, church, they can opt to treat it as a corpus. And there is no requirement or specific direction from the donor that it is towards the corpus. So I think the question is, how do you show that it is for repairs or renovation? So therefore that's something which one will have to take care to see that there is some indication to ensure that it is for the repairs or renovation of that temple, mosque, etc. And the conditions are that it applies only for this purpose, which is etc., invest, etc. So that's the condition over there. So these are the amendments. Now let me quickly run you through the 2 or 3 issues which and which I recently had occasion to discuss this with officers of the exemptions department, and 2 or 3 of these have been really contentious issues. Now the question, as you know, the proviso to 215 applies to only the last limb of the definition of charitable purpose, which is advancement of any other object of general public utility. It does not apply to education, it does not apply to medical relief, etc. And very often the question comes up, what is mean by the term education? And typically you will find in many assessment orders, Bihar mining, Patna High Court decision, etc., blindly applied by the department, saying no, this is not education and therefore this is advancement of any other object of general public utility, this is a business and therefore I am denying you the benefit of exemption. This is the way the department has been looking at it. The Gujarat High Court, and they seem to apply the decision of the Supreme Court in the case of Lok Shikshan Trust at 100 ITR. In Lok Shikshan Trust case, what was happening, the Supreme Court made certain observations. They said that, what do you mean by education? Education means scholastic education. It does not mean anything and everything could be education. When you travel and you see new places, that is an education. When you have a pocket pick, that itself is also an education. But that does not what is meant by the word education. So that's what the Supreme Court said. But that was in the context of a trust which was running a newspaper and claiming that yes, this newspaper, though it is a business, it is still a charitable. That was it in that context. And the courts have subsequently explained the decision of that Supreme Court. You have the Gujarat High Court saying that observations of the Supreme Court do not confine the word education only to scholastic institutions, but other forms of education also are included in the form education. Schooling also means instructing or educating. It therefore cannot be said that education has been given an unduly restricted meaning by Supreme Court in the said decision. Though in the provision of 1022, it need not be given any wider extended meaning, it would surely encompass systematic dissemination of knowledge and training in specialized subjects as is done by the SSC. So Ahmedabad Management Association was holding management training programs. Now that they said is certainly education. The changing times and ever widening horizons of knowledge may bring in changes in the methodology of teaching and in the shift of the better in the institutional setup. So in Samudra Institute of Maritime Studies, this was a case where courses were being run for seafarers. And some of these courses were recognized by Director General Shipping, but many of them were not recognized. So the Bombay High Court said that no, even if they're not recognized by the Director General of Shipping, which is equivalent of University Grants Commission so far as seafarers courses are concerned, They said that even then it does not matter. Still, it is systematic education which is being provided. It is education which is being provided and which is mandatory. But because it is of a particular class of people, therefore it has to be done in that manner. You had the Bombay High Court decision, Indian Institute of Banking and Finance, same view has been taken. They said that for bankers, you're conducting training. Now that obviously cannot be, you cannot say that it has to be a recognized course only, and then employers are recognizing that course, and therefore that is good enough. Delhi Music Society, that imparting of music is held to be education. You have music classes. So it is not necessarily only learning what is in the curriculum of the laid down by the university, etc. That's the way. Mudra Foundation for Communication Research, again postgraduate education, etc., which is for advertising students. This was for advertising employees. So courts have taken that view. This aspect about education, of course, is before the Supreme Court. I'm told that the Supreme Court has heard this in March 2022. The order has been reserved, the judgment has been reserved and still awaited. Similarly, under the proviso to 215, now there again that has been the challenge of before the Supreme Court on various issues. And so far the courts have been reading down the provision, and India Trade Promotion Organization said that any activity, what you have to look at is look at the dominant and prime purpose. Is it running of a business to earn profits, or is it to carry on my main activity? If it is to carry on my main activity, then that cannot be regarded as business. Proviso to 215 does not apply. That's the way the Delhi High Court looked at it. United Way of Baroda, the whole United Way of Baroda is an organization which does a lot of charity, but they hold a Garba program once a year in Navratri, which is attended by people from all over India. People come down, and there are thousands of people over there doing Garba simultaneously. Tickets are very expensive, etc. So there they said that no, this is what are you doing? You're raising funds to pay for your charitable activities, and therefore this is something which is not in the nature of business. So therefore, in that situation, proviso to 215 does not apply. Sabarmati Ashram Gaushala Trust, it was selling milk because it was taking care of cows, aged cows, etc., and cattle. And that milk which was being generated from those cows, etc., was being sold, or it was being converted into dairy products and being sold. And similarly, this was taken by Gujarat High Court. This does not amount to business. Though you may sell it at market rates, just because you realize the full value for those products does not mean it is a business. You're not carrying on that as a main purpose of this, that the whole purpose is different, which is a charitable purpose. Similar view in Nasik, Panchavati, Panchavati, Bombay High Court has also taken a similar view. But as I said, this matter is being examined by the Supreme Court, this dominant purpose test. On 10th of March, I'm told Supreme Court has heard the matter, but decision is awaited. One will have to wait and see what the Supreme Court holds. Hopefully, the Supreme Court will take the same view which has been taken by these high courts. And the last topic which I want to cover is corpus donations received by unregistered trusts. Very often, we come across some trusts which has been set up long back, but they've never been registered, and they've received corpus donations. They've constructed a temple out of that. They've constructed a Jain Derasar out of that, etc. They come to you and say, "Oh, is this taxable? This donation which I've received in the past." Donors have given it clearly for the construction of the Derasar or acquisition of land for the Derasar or the temple, etc. Now, until 1989, the law, if you look at section 224, the definition of income under the Income Tax Act, you have clause 2A, which says that voluntary contribution received by a trust established for charitable or religious purposes is income. Till 1989, it said voluntary contributions not being voluntary contributions towards the corpus. That was the language. The words not being voluntary contribution towards corpus were deleted in 1989, and section 11(1)(d) was inserted. So department's view is that because of that, corpus donations are income of such a trust, and unless you are entitled to exemption under 11 and 12, the corpus donation is also taxable as income. That's the view of the department. Now, the Bombay High Court in the R.B. Sriram Charitable Trust had taken a view that if such contributions are made in a specific direction, that they shall form part of the corpus, and except they shall not form part of the income of the trust at all in the first place. That was the view the Bombay High Court took. And the Delhi High Court had specifically examined this in the context of charitable trust which was not registered under 12A but got registration subsequently under 12A. And they said for the years in which you are not registered also, it is a capital receipt, it is not chargeable revenue receipt, it is not taxable. And the SLP has been rejected by the Supreme Court on the ground of low tax effect in this case. And there are a number of tribunal decisions which have taken the same view. Gaudiya Garantha, Agra Tribunal, Calcutta, Pune, Bombay Tribunal, Bangalore Tribunal in Vokalriga Sangha, and Hosanna Ministries, Vishakhapatnam Tribunal, etc. All these have taken the view that even for an unregistered trust, corpus donation is not taxable as its income. Of course, the question of 56 to 10 has been examined only in one or two of these, where the argument was taken up, but the tribunal said that no, because all the other decisions also have held that this is not income, we also continue to consult for the sake of consistency, we will take a view that this is not income of the trust at all. So this is something again which the department does not agree with, is something which matter will, I'm sure will reach the Supreme Court again from one of these decisions. So this is an area where there is still an amount of controversy, but I think to my mind the better view is that it is not income, it cannot be income. Corpus means capital and it's a capital receipt. 56 to 10 is a general provision when you have a specific provision under section 224, etc. So there what will be taxable is only general voluntary contribution and not, if the legislature wanted it, they would have said voluntary contribution including contributions towards corpus could have been there. If you look at section 12(1) of the Income Tax Act, see, voluntary contributions are not, what is eligible for exemption under the Income Tax Act, under section 11 and 12? Any income from property held under trust. Now, how is a donation or income from property held under trust? Because of section 12(1). 12(1) deems it to be income from property held under trust. And 12(1) says that a voluntary contribution other than towards corpus is income from property held under trust. That's the reason. So therefore, corpus donation is still outside the ambit of income. That's the view which I think is the better view. And even Kankan Palkhiwala, I think when the amendment came, the view, Mr. Palkhiwala at that time was still alive. He had taken the view that no, it is a capital receipt, not chargeable to tax as income. So I think, this is, there are many more controversies. Many of them have been settled. Unfortunate part is one sees that whenever there is a controversy, Supreme Court settles the controversy, the law is amended, you have some, the thing coming. It's almost as if that heads I win, tails you lose, the way the Income Tax Department looks at it. And it's very unfortunate that that attitude is being taken towards charitable trusts. I think during this COVID, charitable trusts have done a lot of good work. Unfortunately, that is not being recognized. It's being felt that charitable trusts are creating problems, and the intention seems to be make it law so strict that people don't want to set up charitable trusts. Unfortunately, that is the feeling which is being brought over here. But as I said, if you want to know what further amendments are likely to come, maybe one is wait for the Supreme Court decisions, which were heard in March 2022, which will come in probably the next month or two, and read that CAG report. What are the recommendations which the CAG has made? The way the CBDT is today, the pro-revenue attitude of the CBDT, I would say there's a 99% chance that those amendments they will bring in, and that to make a mess of the amendments. Unfortunately, that will leave us with too much litigation. In the last few years, we're seeing maximum amount of litigation on charitable trusts, which is not a desirable thing. So their focus should be on doing charity rather than on spending time on litigation. But this is the way, unfortunately, the way position here in India. Well, thank you for a very patient hearing.
Thank you, sir. Thank you for highlighting the recent amendments and issues related to charitable trusts. I now request the chairperson of SICASA, CA Kavita Paramesh, to present a memento to our esteemed speaker and deliver the vote of thanks.
A huge round of applause. We always thought giving money
Ladies
was
and
the
gentlemen,
difficult task.
Please applaud.
Good evening. It was such an insightful session. You will all agree with me that while charities, a very handful of sections are governing charities in the Income Tax Act, but study of charities itself is like an act in itself. So it's such a complex subject. Finance Act 2022 made it even more complex. I think we should all thank CA Gautam Nayak for taking his time out and making it simpler for us to understand. At least some things have settled in our mind with this session. Thank you so much, sir. On behalf of Bengaluru branch, as well as all the other 7 branches of Karnataka, we wholeheartedly thank you for taking your time out and sharing your knowledge with us. Thank you, sir. Thank you.